When you're self-employed or running a small business, how you allocate your income makes a huge difference on how much tax you pay and how much money you actually get to keep. Let's walk through a real-life example of $150,000 business income. And I'll show you exactly how I'd structure things to maximize business growth, minimize paying taxes, and still live comfortably. First off, you gotta pay your corporate taxes. In BC, for a small business earning about $150,000 in profit, that rate would be about 10%. So your total so far is $15,000 in corporate tax and $135,000 remaining to allocate. Step 2, I would reinvest back into your business. The fastest way to grow your income for next year is to reinvest some of what you made this year back into the business. In this scenario, I would set aside $33,333 for reinvestment into marketing, new hires, software, training, and things like that. By leaving that money in the company instead of paying myself, I'd reduce my personal taxable income down to $101,667. Pro tip: reinvesting back into the business not only fuels business growth, but it delays paying personal tax until you actually withdraw that money. Step 3 would be to make a charitable donation. Next, I would support a cause I care about and get a tax break. Let's say you donated $1,500, your tax credit would be $375. Charitable giving is one of the most straightforward ways to reduce your tax bill while doing some good. Step 4, make sure to claim all your deductions on your personal tax return. Don't forget to claim all the deductions you're entitled to. Even small write-offs can really add up. Here's how that looks in this example. Let's say your home office write-off is 4% of your total home expenses, because your home office takes up 4% of your total home square footage. Let's say this comes out to a total deduction of $792. Then let's say your cell phone and internet deduction comes out to $660, and your business use of personal vehicle deduction could come out to $950 for total personal deductions of $2,402. After all these deductions, your taxable income drops again to $98,890 in taxable income. Now at step 5, I would estimate my take-home pay. At roughly $98,000 taxable income, the amount of tax you would be paying would leave you with an after-tax income. Your after-tax take-home pay would come out to roughly $74,167.50. That comes out to an after-tax monthly income of $6,180. This is the money you'll use for your actual life, like groceries, housing, travel, savings, and more. Now for step 6, you need to build a smart monthly budget, ideally following the 50-30-20 rule. Here's how I'd break down that $6,180 a month using the 50-30-20 framework. 50% allocated to needs works out to $3,090. For rent, groceries, health, insurance, and other essential spending. 30% for non-essentials works out to $1,854 for dining out, entertainment, and travel. And finally, 20% for savings and investments works out to $1,236 to put into your TFSA and your emergency fund. This structure keeps your finances balanced while still building wealth for the future. This example shows how a few intentional decisions, like reinvesting into the business, claiming all your deductions, donating strategically, and following a smart budget can save you thousands in taxes and set you up for long-term financial success. Now it's your turn. Try this exact same exercise with your salary or net business profit. How much could you save if you optimized every dollar? And if you're not sure where to start, that's exactly what we help clients with at Pacific Ledger Bookkeeping. The earlier you plan, the more options you'll have at tax time. Even small changes now can add up to big savings later. As always, if you like this content, don't forget to like and subscribe.